All right, everybody, we are 2 minutes past the hour, and I just want to say thank you for everyone who's joined us and taken some time out of your day. This is one of those topics that I will say that it's not a fun one to think about. But as you can see from the name on the slide there, or the title on the slide there, we really want to inform our clients of Cornerstone Advisors of just what their options are for long-term care. And this is one of those subjects that I think has affected many people in many ways, whether it's a parent or an individual, maybe a spouse, but the costs are really staggering, and it's just good to know what, in fact, your options are. Before we get started, and any of you who have joined our webinars before, you'll know that I always like to introduce them by telling you a little bit about who Cornerstone is. And the reason for that is you may have no clue why you got an invite to this webinar from Cornerstone. And there's a reason for that. First of all, just to give you a little bit of background on who Cornerstone is, there's about 120 financial advisors across 15 states. They came from 17 different prior firms on their journey toward being an independent advisor. The firm itself was started in 2005. And if you total up all of the client assets that all of our 120 plus advisors manage for their clients, that's about $7.3 billion total when it's all said and done. Now, the reason why you may have no idea who Cornerstone is because your financial advisor has chosen to brand as something other than that. And you'll see many of the logos on the screen: LifeMap Wealth Management, Ginfinity Wealth Management, Steamboat Financial Group, Stone 8, brand new one down in Oklahoma, NMLT Wealth Management. There's a very good chance that you know your financial advisor under that moniker, and that is something that we fully support. Now, all of those advisors are doing business with or using as their broker-dealer LPL Financial. A little bit about LPL. They're the largest independent broker-dealer in the country. They have #1 market share for independent broker-dealers, over $1 trillion in total assets under management for clients. But there are 0 proprietary products. That's part of being independent. The advisor is empowered to really do what is absolutely right for the client and not feel like they have to use an in-house product or in-house service. They can really figure out what that best thing for the client is and the best thing for their practice. Now, what all that really means for you is support, structure, and scale. And the way this all comes together, and you can see what looks kind of like a fidget spinner on the screen, is you have your independent financial advisor. They've decided to do business with LPL Financial to help custody assets, allow for product offerings and product availability. They create the statements that are sent out to you, but they've also partnered with Cornerstone to really help them do things like this webinar to take some of that off of their plate and allow them just to spend more time with you. And really, that's the goal for every financial advisor out there, is to spend more time with their clients. That is probably the best way to spend their time. And as I mentioned, this webinar is something that is just one example of that we try to do for our financial advisors, just to provide leverage to their overall business. Now, my expectation is that we will have some questions about this topic, long-term care, and you're unable to use the chat function in this webinar. In fact, it's disabled. You won't even see it. So if you do have questions, the one and only way to ask those questions is to use the email that you see on the screen. And that's Cornerstone WM, no dots, no spaces, Cornerstone WM @lpl.com. Those emails will come to me, and I will relay those questions either to Michael or Steve at the end of the webinar. So just keep that in mind. I will reiterate that at the end before we start taking the questions. So if you do forget, no problem, we'll remind you. But again, Cornerstone WM @lpl.com. And by the way, this webinar is being recorded. Your voices won't be captured. Your names won't be captured, none of that. But at the same time, I do just want to be very clear with you that it is being recorded. And so if it is something after the fact that you'd like to share this with a friend, your advisor will have access to it and will be able to pass that along. I'm going to stop sharing. And Michael, if you'd like to start sharing, you're welcome to. But I'm very pleased to have as our guest speaker today, Michael Tesler. He is the president of BUI. BUI is a local insurance brokerage. And again, getting back to that idea of being independent financial advisors, our advisors can choose to work with firms like BUI really to bring them in as an expert or an extension of their team to really allow them to fully help the client understand really all of the different options that are available to them and not really have to go out and be an insurance expert themselves. Michael has partnered with financial professionals to implement wealth transfer and wealth protection strategies. And he's spoken to thousands of advisors and financial planners and attorneys and accountants and the like to discuss various planning strategies using life insurance and long-term care insurance. When Michael isn't helping financial professionals implement the best planning strategies, you can find him spending time with his family or playing tennis. But again, Michael, really appreciate you being with us today, and the floor is yours.
Bill, thanks so much for that nice introduction. I really appreciate it. If this meeting were taking place, say, 25 years ago, I would probably start by sharing with you some overwhelmingly scary statistics about the percentage of people who are going to need help as they grow older and the percentage of people who have a chronic care situation and so on and so on. But the truth is, we've kind of moved past that at this point because it seems that almost all people who've been around have already become aware that this is a pretty significant topic. And as mentioned, I speak to a lot of different folks, and whether I'm standing in front of a group of 20 people, 200 people, or 2,000 people, when I say, hey, if you've had a situation that involved chronic care for a family member that impacted your life, raise your hand. Every hand in the room goes up every time, whether it's a small group or a large group. So understanding that this is incredibly widespread, happening all over, we can get past all that. And what we can do is move more into what we want to talk about today, which is what long-term care insurance is all about. You will notice as we move through our program today, there will be no mention of any specific insurance company or mention of any specific insurance company's product. This is about educating you and providing you with the necessary information to hopefully make important and prudent decisions about your own personal situation. So with all that said, let's jump right in. So what is long-term care insurance? By definition, it will insure the financial risk, all or part of the financial risk for somebody who needs care. But that's a nice definition, but I really like a different definition, which is, let me tell you what it's not. And let me tell you where it, what doesn't happen here. So for a lot of people, they're under this impression that if they're still working and they have medical insurance through their employer, that medical insurance would cover the things that long-term care insurance does, and it won't. People who are retired and have Medicare and Medicare supplement plans have the assumption that those plans are going to cover if they need chronic care, and the answer is they don't. So long-term care insurance isn't about medical insurance. It's about providing care when you need it. So if I need surgery because of a significant situation in my life, obviously that's going to require a doctor and a lot of other folks, and that's all going to be covered by my medical insurance plan. If I reach a point in my life where I can't get myself out of bed without somebody helping me, I can't get myself to the bathroom without somebody helping me, I can't feed myself without somebody helping me, then all of those things, I don't need a doctor for those things. I don't even need a nurse for those things, but I do need help. And that's where long-term care insurance fits in. A lot of people have the sort of an old school notion that we're talking about what used to be called nursing home insurance. And that is not what we're talking about, because I will tell you that a huge percentage of the people who receive benefits from a long-term care insurance policy are getting those benefits at home, and it's where most people want to stay. Interestingly enough, the insurance company that has the largest block of traditional long-term care insurance out there reports to us that over 3/4 of their claims are for services that are being provided in the home, not in a facility. So that gives you a sense of what people are trying to do. And what they're trying to do is maintain the optimum level of independence, to be able to stay in the house that they are familiar with, et cetera, et cetera. So let's talk for a minute about who the typical candidates are for the purchase of a long-term care insurance plan. Generally speaking, they are between age of 50 and 65. Now, that doesn't mean that people younger than 50 or over 65 don't make this purchase. They do. But if you really look at the largest percentage of them, they are between 50 and 65 years old. And overwhelmingly, this group of people has had a long-term care situation in their own family. They have either been a provider of care for someone in their family. They are currently a provider of care for someone in their family. They've watched the impact on parents or grandparents who had to be care providers in their own family. They've watched the financial impact on the family. You know, it's one of those things you only have to see it once to really feel like this is something I want to deal with. Now, in the spirit of full disclosure about myself, there's something you should know in addition to the nice comments that Bill made at the beginning of this meeting. Of my 4 grandparents, 3 of them were in facilities for 8 or more years. And when you take it down the next generation and you go to my parents and my in-laws, my father-in-law spent the last 10 years of his life with round-the-clock, 24-hour-a-day care for the last 10 years of his time on this planet. So I've had very, very significant care situations in my family, and I will admit to you that certainly has impacted my passion and my feeling about all of this. I will also tell you that for people who want to buy this, these are people who understand the risk associated with it and want to have the best possible options for themselves. So, how does one get benefits from a long-term care insurance policy? Well, basically, there are 2 ways. Either way, a physician will be asked to provide a necessary assessment, answer questions, et cetera, by the insurance company that's offering the insurance to demonstrate that somebody either has one of 2 things that would qualify them for benefits. The first one is that they have a cognitive impairment. We're talking about dementia, Alzheimer's, things like that, something that would preclude somebody from taking care of themselves. The second thing is that they would not be able to do 2 of 6 activities of daily living. And ADLs, or activities of daily living, are common to all insurance companies out there. If you've read articles about long-term care, whether it's in Art Magazine, whether it's in the Wall Street Journal, you'll always hear about activities of daily living. So when somebody reaches a point in their life where they cannot bathe themselves, they're incontinent, they can't get themselves to and from the bathroom, they can't feed themselves, they can't dress themselves, and they can't transfer. In other words, I cannot move from this chair over to the next room to sit on the couch without assistance. When you cannot do 2 of 6 activities of daily living, you qualify for benefits under a long-term care insurance plan. So very quickly, 1, if you have a cognitive impairment, or 2, if you're unable to do 2 of these 6 activities of daily living, generally speaking, you would qualify for benefits on a long-term care plan. So let's define a few terms that are generally associated with long-term care insurance. The first one is indemnity. When we talk about a plan that has an indemnity benefit, it means that if you go on claim, you get the whole benefit. In other words, if you have a $5,000 long-term care benefit and you go on claim, you get the entire $5,000, even if you're not spending $5,000. Maybe you only need somebody in your home a few times a week to help out, those kinds of things. But either way, if you've got that benefit, you get the whole benefit. A reimbursement plan differs in that it reimburses expenses that you actually incur. So it means that if you are paying a service provider to come to the home a few times a week and you incur a total of $3,000 in services, a reimbursement plan would reimburse you for the $3,000 that you spent. And oh, by the way, if you had that $5,000 benefit that I just mentioned, the remaining $2,000 stays in your benefit pool. And we'll discuss what that means in just a minute. The benefit period is usually described in years, sometimes in months, for how long you will have that benefit. So you may have a $5,000 benefit for a 3-year period of time. And if you do quick math, if that's $5,000 a month by 12 months, that's 60,000. If you have a 3-year benefit period, that means the total amount is 180,000. That's your pool of money. So when you hear somebody talk about the pool of money on which you can draw down, they are referring to the amount that you can get per month and how long you can get it. That makes a pool. Now, earlier I said if you have a reimbursement plan and you don't spend it all, it stays in your pool. So that means that this person would have potentially more than a 3-year benefit if they were only using 3,000 of their monthly benefit amount, because the other 2,000 would remain in the pool. The elimination period refers to the period of time before the insurance company will actually pay benefits. So you have provided the necessary documentation that says you qualify for the benefit, and then there is usually a period of time before the insurance company pays it out. That can differ, and that will certainly change the cost of the insurance that you purchase. It can be as little as 0, so that it is available to you day one, or it can be up to 6 months. So if you feel comfortable that your assets would make it comfortable for you to wait 6 months before you start getting your benefits, you can have a longer elimination period, which, by the way, will generally translate to a lower premium amount. And the last one that we want to talk about is inflation protection. The better plans in the market will always offer inflation protection. In other words, a percentage increase of the amount. Because one thing I can tell you about long-term care insurance is that the cost of the benefits and the cost of receiving care are going up, and they are going up at a significant rate. So having inflation protection is something generally we would always recommend to you. So for many, many years in the market, there was a type of plan that we generally refer to as a traditional long-term care insurance plan, and it was the primary plan in the market. However, today that is not the case, and we're going to talk about why that is. A traditional long-term care insurance plan was somewhat customizable in terms of how much you got for services provided in a facility and services provided in the home and so on. The initial premium on these plans was very, very low, making them attractive. However, here's where the catch comes. Traditional long-term care insurance plans do not guarantee that the premium won't increase or that the benefit won't decrease. And unfortunately, many insurance companies did not price these products correctly, and as a result, there have been massive rate increases in the market. And I'm not talking about a 5 or a 6% rate increase. I'm talking about premium amounts that have doubled for some of the people and tripled even for people that own these types of plans. In addition to that, these plans have sort of a use it or lose it kind of a thing. If you stop paying your premium, the benefit goes away, it's all over with. If you're lucky enough to have paid premiums on it, go through your whole life and never need the care, at the end of life, there is no death benefit. There is no return of any of that premium. So those were some kind of big concerns from people who were buying this type of plan, but by far the biggest was these rate increases. I know that you probably can't see the screen in front of you very easily, but I want to just go through it very, very quickly and tell you. This is a real letter. This one is old, and the person involved has obviously been removed, but so that we protect the innocent. But this exact same letter is being used today, and this is the letter that this person received announcing to them that they would be experiencing a 50% rate increase in the cost of their long-term care insurance. And if they couldn't stomach or afford that 50% rate increase, then there were ways to reduce the amount of benefit or the duration of the benefit or increase the elimination period so that the rate increase was not as painful as it would have been just keeping the exact same plan. This person got this letter, as you can see, in 2016, They've had more of these letters since. So that's why the traditional long-term care market has shrunk to be a teeny tiny part of today's current long-term care market. Today, hybrid plans, as we like to call them, are by far the biggest part of the long-term care market. And more people making the purchase of long-term care insurance buy a hybrid plan by, factors of 20 to 1 as compared to a traditional long-term care insurance plan. So very, very different. Hybrid is the new normal. And there's some pretty legitimate reasons why. A hybrid plan, by definition, is a life insurance plan married together with a long-term care insurance plan. But nobody buys it for the life insurance. This isn't about buying life insurance. I'll explain why the life insurance is not unimportant. What this plan does do, however, it guarantees the amount of premium, whether you set it up to make one premium payment, whether you set it up to make 5 premium payments, whether you're making premium payments for the rest of your life. Those premium amounts are guaranteed. The benefits provided by the long-term care portion of this plan are also fully guaranteed for the rest of your life. If you've bought a plan that has inflation protection, excuse me, and the long-term care benefit amount is going up, that inflation protection is fully guaranteed. If you've bought a plan that has a return of premium option or a cash value option, that is fully guaranteed. And of course, the death benefit, assuming that you never use this plan, the death benefit is also guaranteed. However, as you use these plans, the death benefit is reduced by the amount of LTC claims activity, but there's always some amount of death benefit in the end. Now, when it comes to a hybrid plan, you can get both, either a reimbursement plan or an indemnity plan. And for almost all of the better carriers in the market, there are discounts, for marital discounts. And if spouses apply together, they will enjoy discounts on hybrid plans. The average age of a person who purchases a hybrid plan is 57 years old, but I will tell you that age is coming down quickly. In fact, in my own career, I can tell you that number has come down 5 or more years, because younger and younger people are buying these plans. And in most instances, it's because they've watched parents or grandparents have significant chronic care situations. There is a benefit period available between 2 years and lifetime. And there are reasons why these things may make sense depending upon your personal financial situation. You can make a variety of different payments into these plans, pay it all off at once. You can pay them in a relatively short period of time. So many times when somebody is still in their working years, they would like to get the plan paid for as rapidly as possible. So they may do 10 payments so that this does not become a retirement expense for them. And they're more comfortable doing it that way. And then some would just rather pay on it for the rest of their lives. I will tell you that for a lot of these plans, people who have old life insurance policies that no longer are serving the purpose for which they made that purchase can repurpose the cash value in that life insurance by way of a 1035 exchange and use that money to buy a significant long-term care insurance benefit. Now, when we talk about hybrid plans, we like to think of things as simply as we possibly can. And what I mean by that is, think of it as providing 3 different pools of money. The first pool of money is the long-term care benefit. If you live long enough, statistically speaking, literally it's overwhelming that you are probably going to need some care. And that bucket that says live is that pool of money that will be available to you as a long-term care benefit. If you're among the lucky and you live a very long and healthy life and never end up needing the long-term care insurance, there will be a death benefit. And with most of the better plans in the market, the death benefit, if assuming that no benefits were taken from it during life, that death benefit will likely be equal to or greater than the amount of premium that was paid. And if for some reason that you want to get out of this plan, Most of the better plans will provide you with a return of premium or a return of a portion of your premium. Usually it's somewhere between 70 and 100% of the total amount that was paid into the plan. This is very interesting, however. The company out there that has the largest block of hybrid long-term care insurance business reports to us that fewer than 2% of the policyholders have ever exercised the option to get out of the plan. In other words, once people buy these plans, they recognize the important role that it plays in their retirement, the important role that it plays in their family, the important role it plays with their finances, etc., and they generally do not get rid of this coverage. So let's take a look at a real case situation for just a moment. This is a 55-year-old female, and she is a healthy non-smoker. She decided to use $100,000 from her portfolio to make a one-time purchase of a hybrid long-term care insurance policy. Her goal, I can tell you, a real situation, her goal was to not be a burden to her children, to make sure that there were adequate funds immediately available without having to sell things or do things, to take care of her should the day come that she needs care. And what did that $100,000 buy for her? I ask you to pay attention to the left-hand side of this screen just for the moment. It bought for her a pool of long-term care money of $459,000, or $5,920 per month to be used if she had a care situation. It provided a 6-year benefit period, so it would pay that $5,920 per month for 6 years, and it has a 3% inflation protection amount. The death benefit on this plan is $142,000, as I said earlier, in excess of the amount paid in. And if she wishes to get out of this plan in year one, 80% of her premium would get back to it. Now, for those of you that can't tell by looking at me, I will tell you that I am not too many years past that 55 mark. And it is very difficult for me at my age to think of myself needing long-term care. But it's a lot different when I start thinking 25 years into the future and the reality of knowing that, yeah, it's possible I could be in a chronic care situation that far down the road. So what I'd like to do is age this nice lady 25 years. So you'll recall she was 55, she's now 80. Because of the increase, the 3% inflation increase, the pool of money is now up to $934,000. She could access $12,035 per month. Oops, sorry. She could access $12,000 per month over a 6-year period of time. Her death benefit still at $142,000. So as I said, if she is lucky enough to have lived a long and happy life and she passes away, $142,000 goes to her chosen beneficiaries. And if for some reason at 80 years old, perhaps the government's decided they're going to take care of long-term care. For those, I can't see you and I can't hear you. Hopefully you're laughing right now, because trust me, that will never happen in any of our lifetimes. But if this lady wanted to get out of this transaction, she could get her whole $100,000 back. Now, the good news about all of the numbers, whether we're talking about year 1 or year 25, all of the numbers on this slide are fully guaranteed. The amount of premium, the amount of long-term care benefit, the inflation protection and the growth in that long-term care benefit, the cash surrender value, and the death benefit are all fully guaranteed in this scenario. So the insurance company guarantees all of this so that you need not worry. And unlike the old traditional plans, you're not going to get that letter in the mail that says, hey, we know we said it was going to be this, but it's actually going to be that. Which is why one among the biggest reasons why these plans now are the vast majority of the market. So I have now come to the end of my prepared comments, and at this time, I would be very happy to entertain questions from any of you if you have questions about anything we have discussed. And Bill, if it's all right, I'll stop sharing, or I can keep the sharing on if somebody wants to go back to a particular slide.
Yeah, sure, Michael, that's your choice. You can do either one if you like. Remember, as I mentioned before, folks, if you do have questions, the way to ask those is email cornerstonewm@lpl.com. Once again, all one word, cornerstonewm@lpl.com. Those will come to me. I'll relay those to Michael and Steve. And I did realize that as we were, or as I passed things over, I didn't introduce Steve, which was kind of rude of me. But Steve and I have actually known each other for quite a long time. Steve is our local representative for BUI and is just a great partner of a lot of our advisors here at Cornerstone. So, Steve, I appreciate you being with us today as well.
Absolutely. Thank you.
And Michael, I will maybe throw out just a couple of things, as I was listening to you. First of all, I love the way that you tied this into the overall financial plan for clients. And, when you start to think about what their options really are, it's number one, self-insure, which means save a ton of money and hope that you don't run out. Number two would be partially insure. Maybe you cover some of that and then self-insure with the rest. Or the third one would be fully insure or potentially fully insure. All have different price points along the way. Or I guess there's a fourth option, which is just, roll the dice, see what happens, right? That's maybe not much of a plan, but it's certainly an option. But the one thing I did want to maybe just reiterate and maybe summarize what you said was the good part of the hybrid plans that are available now is, unlike the older long-term care plans of the past that were use it or lose it, kind of like homeowners insurance. You really only get the benefit if the house catches on fire. With this, there at least is something that the client could get back, either in the form of a return of premium or in a death benefit as well. So, that certainly straddles that line and maybe gives folks a little bit more comfort in terms of this isn't just money that's going to be thrown away.
You make an excellent point, and you are right on. Whether it's by way of long-term care benefit, death benefit, or a cash surrender, most people will get all, or at least the vast majority of what they have put in out of the plan. I would also tell you one other interesting thing. It's funny that you talk about the use it or lose it on a house situation. It was, people were really bothered by the fact that on their long-term care they could put money in until they were, way old and then pass on and never have used it. I've never once at the end of the year thought to myself, I wish my house had burned down so that I could have used that insurance. So be happy if you don't have to use this coverage, although statistically speaking, odds are not in your favor.
So I do have a couple of questions that are coming in, but I do want to maybe ask one more. And this was something that we were discussing before the webinar started. And this might, again, just be one more option. And I think you made it very clear that this is maybe not always the best option. But for those individuals who might be on the call right now, or those advisors who are listening in on the call as well, if someone has a non-qualified annuity, and so to be clear on that, that means an annuity outside of an IRA or a 401k or a 403b, something that's outside of a qualified plan. There are actually annuities that have long-term care riders that those assets could be moved into, and then the distributions, if used for long-term care in many circumstances, or at least a portion of it, would be treated as a tax-free withdrawal. Could you maybe just talk about that very briefly, but then also maybe talk about why that's not always the best option?
You summarize it very well. There are annuity plans out there that have a long-term care rider that would allow for the use of that money. It's your own money, of course, but use of your money. But if you would normally have had a taxable gain to pull it out, if you're pulling it out for the long-term care via the rider, it will come out without the same tax consequences. And again, I cannot give tax advice to anyone here. You would want to discuss that with your tax advisor. But yes, that is accurate. These plans are usually used in a situation involving one or both of these circumstances. Number one, somebody has an old annuity with a very low cost basis and a very large gain, and they are reluctant to do anything with that asset because if they start taking money out of it, they're paying taxes, and you're paying ordinary income tax, not even capital gains. So, to some tax avoidance, if you will, by thinking about how to use that in a long-term care situation. In addition to that, because you're basically drawing out your own money, the underwriting is much different for an annuity with a long-term care rider as compared to the underwriting on a very robust hybrid long-term care plan that has terrific benefits, et cetera, et cetera. There is definitely underwriting to go through there. So it's a different situation. And again, every person's personal circumstances would dictate what makes the most sense for them.
So dollar for dollar, you could probably get more coverage if you were buying a specific long-term care policy. But for those individuals who might struggle to get through underwriting, that could be a good option.
Absolutely.
Yeah, and I'll just jump in real quick, Michael. If you could take a second and touch on, I know you had explained how the hybrids are built on a life insurance chassis, essentially. Some people I'm sure with us have been through underwriting for life insurance. Since it's a life insurance plan, are we talking about the same underwriting, or what is or isn't involved?
Steve, thank you. That's a great question. And the answer is it does differ slightly from life insurance underwriting. First of all, there's very rarely an exam involved. Almost all of the underwriting is done by an interview with the insurance company, where they're going to ask questions of you about your health. Some of the questions are cognitive in nature, and then they will receive information from your doctors of what's called an attending physician statement, where they will receive records from your doctor, but rarely is an exam involved in terms of getting through the process. It also differs because there are things that might not preclude you from getting life insurance that would almost definitely preclude you from getting long-term care. And let me just give you one quick example. If I was perfectly healthy, head to toe, with the exception of the fact that due to an injury or an accident or something, I use a cane to get around and have a limp or something like that. For life insurance, it's possible I could get the best underwriting classification available. For long-term care insurance, I would likely be a decline, because if you have to use any kind of an apparatus to move around, generally speaking, you would be a decline for long-term care insurance. So Steve makes a great point in that it's, even if you've been through life insurance underwriting in the past, the processes are definitely different.
You know what, you both just touched on a question that came in from one of the folks who are listening in right now, and you mentioned using a cane. What are some other things that might make someone ineligible for long-term care?
The list is kind of big, but what you have to think of it differently. It's the kinds of things, instead of with life insurance, we think of the kinds of things that might shorten our life. When it comes to long-term care insurance, we're thinking about the things that might make it impossible for us to get around and take care of ourselves. So if somebody is being treated right now for arthritis, osteoporosis, and things like that, it's highly likely they would have trouble getting long-term care insurance. If you're right now getting steroids on a pain situation in a joint somewhere, likely not long-term care insurance might not be available to you. If you are using any kind of an apparatus to get around, I already mentioned a cane, but if you're using a walker, wheelchair, or anything else, it's highly likely that you would not be eligible for long-term care insurance coverage.
Okay. Kind of last call for questions for folks. Again, if you have any that you would like to ask, please email them to cornerstonewm@lpl.com. But the last one I have here in the queue is, do you, and I'll point this to BUI, do you have a questionnaire that someone could complete to determine whether or not they're eligible for long-term care?
That's a great question. We do. And if you reach out to your financial advisor, they can reach out to BUI, and we can provide that to them so that they can, you can get through it and see. And then we, on our team here, we actually have full-time underwriters on staff here who can review that. This is not an application for insurance. There's no permanent record or anything like that. It's just an opportunity to get a quick assessment of your insurability. And if you have something on your mind that you think is significant, be sure to include that on the questionnaire.
Yeah, and I'll add one more question, Michael, if Bill, you want to wait and see if there's any more after this, but a common one that we usually get is from someone who has a traditional plan, as Michael mentioned, or has seen a family, or who has a family member who has a traditional plan, and they're starting to see those increases that Michael displayed in that summary. So I know I feel the call almost daily. I'm sure Michael does as well. You know, I have a plan and I'm getting that increase. What should I do?
It's a great question, and Steve's right. Those kinds of inquiries come into BUI from advisors on a literally daily basis. And the quick answer is, it depends. And I'm sorry to give a vague answer like that, but every person's situation differs. If you're 80 years old, you're probably not insurable for any kind of a new plan. And even if you were, the cost of the new plan would probably be greater than the old plan, even with the rate increases. Highly likely that we would recommend you do anything other than hang on to that plan and stomach the rate increases. If you're 55 years old, that may be a very different scenario. If your health has changed since you bought the original plan, et cetera, et cetera. There's so many things. So the answer to the question is to reach out to your financial advisor, who can get with Steve and or with me, and we can help you review what you have. And we literally have a process for doing those kinds of reviews and help determine what might make the most sense for you.
So actually, we do have a couple more questions that came in, and actually, Steve, one, I might just, a couple of advisors emailed and said, hey, I'd like that questionnaire, so it might be good just to forward that to me, and I'll make sure we get that in our advisors' hands so they have it ready if they have any clients who are calling in after this and have questions.
Sure.
Here's a question that came in, and the question is, how many years out can you purchase the plan for, or is it a plan that lasts a lifetime? And I'm assuming that probably is talking about, coverage of benefits, how long that can last. And, I think Steve or Michael, maybe you touched on this in terms of like the pool of assets that's available, but maybe you could expand on that.
You can buy a benefit period somewhere between 2 years and lifetime. I will admit that relatively few people veer toward that lifetime. Relatively few people veer toward 2 years. And again, you only need to look at some of what we've already talked about here. These things can last a long time, but you can look at averages. I'm not a big fan of that, to be honest with you. You can look at family history situations. There's a lot of ways to get there, and of course, cost is going to play a role in it. And Bill, as you said earlier, not everybody chooses to insure for the entire amount. Somebody may look at this and say, look, I can cover myself for a period of time, but if this thing ends up lasting 6, 8, 10 years, I think that I would like to know that there's some insurance in place to help that, and let the insurance cover the first 4 years. And if I'm still, in need of care, I'll take over after those 4 years, kind of a thing.
So last question, and I'll have to interpret this one a little bit, but the question was just very simply availability of policy illustrations. And I kind of want to go back to maybe discussing a little bit about BUI and being independent financial advisors and so on. BUI works with a number of different carriers. Our advisors can work with a number of different carriers. So that is really going to be based on what policy or policies make the most sense. But maybe you guys can expand on just the process for getting a policy illustration.
Yeah,
Sure.
Absolutely.
Oh,
go ahead, Michael.
I was just going to say, we use a terminology. that we like a lot. We are carrier agnostic. If a carrier meets the necessary financial criterion, and if the plan that they offer is truly consumer friendly and attractive, we're interested. There is no carrier that pays for shelf space at our place. There is no carrier that controls our place. Like you, we are 100% independent. And you and your team obviously are 100% independent. So any recommendation made to a client is made based on the fact that you believe that the plan involved represents the best consumer-friendly value for that client. And I will tell you this, that in the long-term care insurance hybrid market, it's a small market. When it comes to term life insurance, as an example, there's like dozens and dozens of carriers out there that manufacture term insurance. There's a relatively small number of carriers that are in this market. So there's not dozens and dozens of options, but the carriers that are in this market do a great job. They have great plans, very similar to what we just went through in the presentation. Steve, I'm sorry, were you going to add more to that?
No, I was just going to say, we're happy to customize plans for anyone at any time. In fact, we have an evaluation process, which is part of what I'll send over to you, Bill, where the clients can fill out a questionnaire. And then we're going to have our underwriters take a quick look at the health information. And then we're going to have our case design folks go out and survey the market for all of the carriers available. And, they all have their own little niches. So if we're looking at a male that's 50 years old and wants to do a single pay, that could be one carrier that might come out as the best option. If you're looking at a female who's 62 and wants to do a 10 pay, it may be another carrier. But as Michael said, we go out and we survey them all and try to find the best fit for any individual, or in some cases couples.
So to start that process, it really would be call your financial advisor, say, hey, I'm interested in seeing what this would look like. And then they can reach out to you, Steve, and get the ball rolling.
Absolutely. They can fill out that questionnaire that usually takes about 5 to 10 minutes. And, I can't echo what Michael said enough about the hybrid products. And I think that, using them as a planning tool, he used the word guarantee so many times. You know what's going to happen. Should you get through underwriting and get approved, what your benefit is going to be each year and for how long. So as the financial advisor, you can look at those numbers with your clients and have the conversation, say, does this make sense or not?
So I did get one more question, and we'll make this the last one, and then we'll wrap up. But the question, I think this is a very good one that a number of folks might have on their mind. I have a traditional LTCI plan. Can we roll this over into a hybrid plan?
The quick answer to that is you potentially could replace it, but most traditional plans have no surrender value. So when you come out of that plan, there's nothing to quote roll. And before anybody would do something like that, there needs to be some analysis around it. Even though it's frustrating to have to weather the rate increases and everything else, if the new plan doesn't make sense, it still doesn't make sense. Only replace when replacement is appropriate.
Yeah, so in other words, just what am I giving up versus what am I getting? And there has to be more in terms of what I'm getting to really make that make sense.
Yes. And sometimes that's not just financially, but for some people, this idea that, look, I'm in my 60s. I think I'm going to live into my 90s. I'm not sure I can, sleep at night knowing I got 30 years of rate increases ahead of me. That peace of mind counts in here too. So it's there's a lot of factors that weigh in on what would be the appropriate course of action for that person.
Well, Steve and Michael, excuse me, I can't thank you enough. This was very valuable. I know I learned some things, and I'm sure all of our participants on the webinar today did as well. Really appreciate your help with this. Really appreciate your time today, as well as everyone who joined in. I'll go back to something that was mentioned before for the participants who are on the call. If this is something that you'd like to explore or it makes sense, call your financial advisor and they can get the ball rolling for you. But again, really appreciate your time. Have a great day, everyone.
Thanks everybody.